Hello, it's Wednesday, December 4th, 2019. I'm Steve Houston with Compass Communications, and I'm here again with Joe Terrell of Terrell & Company. We're going to talk about a little bit about the markets and investing as we approach the end of 2019. And Joe, about the world economy. We talked beforehand that it is definitely slowing down. The Institute of Supply Management Manufacturing Supply Index is down for the fourth month in a row and down quite a bit. We appear to see a lot more contraction. What's going on here? What are you seeing?
Fears over trade policies around the world and fears over potential tariffs are hurting business confidence. Businesses are without question postponing spending, and you see it in things like the index you mentioned. In conversations we have with companies, it's a common theme that they are postponing activity for 90 days, 6 months to see what's going to happen about trade policy. And then if you add to it things like the president just in the last 4 to 5 days threatening Argentina and South American countries with trade tariffs. Yesterday, I think it was, he threatened France with trade tariffs. Earlier this year, he threatened Mexico over trade tariffs because they didn't. It's very counterproductive. It makes companies all over the world decide maybe they should postpone until some of this gets clarified. Where you see it quite a bit is in Europe, where his continued threats about he might impose tariffs against European automobiles in the United States has created a situation where in this country people are reluctant to spend. A lot of those European auto companies have manufacturing facilities in the United States. It's creating a scenario where both sides decide, let's just postpone our spending until this gets clarified, and consequently you are, without question, seeing the world economy month by month gradually and continually slowing.
So they've made their business plans for 2020, but they're struggling with considerable uncertainty as to how to execute those plans.
Exactly.
Okay. So, and you mentioned it, and it was in the headlines that today the Dow dropped 280 points on trade fears. It hasn't been an overly volatile market this fall, except when we have moments like this. But the president again said he didn't appear to be wanting to resolve the China trade war until after the elections, and as you mentioned, he appears to be opening up a new front against France, Argentina, and Brazil, and all of that is playing into the uncertainty.
Yes, it is. Yesterday being a good example, at least as it relates to the markets. At one point, the market was down almost 500 points. If we're not going to clarify any of this trade issues, whether it's with China, whether it's with Mexico, whether it's with Europe, if this isn't ever going to be clarified as to, okay, we have an agreement, it's over with, the constant threat of tariffs is no longer an issue. If that's not going to happen, the world economy is going to continue to slow, and eventually it'll catch up to investment markets.
And since we last met, the big news that people were talking about was that the markets hit a new high. The markets hit a new high. You know, I had a friend the other day tell me that markets haven't made a round trip yet. So Joe, you agree with my friend that the markets haven't made a round trip yet. What's likely to change to make that round trip?
Great question, and I'm glad you asked me. Right now, markets are being fueled, whether it's bonds or stocks, fixed income, whatever you want to say, by an incredibly low interest rate environment all over the world. That interest rate environment is dependent upon central banks all over the world continuing to be able to create money, if you will, to keep these interest rates at 500-year lows. We're also just barely beginning to see inflation begin to pick up. You can't have central banks just create 30-40% more currency in order to buy bonds to keep interest rates low without that eventually creating higher rates of inflation. In our opinion at Terrell and Company, you're just beginning to see the very early stages of that. That's what we're watching very diligently, because you could get into a situation where central banks are forced to stop this policy of pushing rates and keeping them down at 0 to 2%. And if they cannot arbitrarily keep that going because inflation's beginning to pick up and you see interest rates just tick back up from not 0 to 2% around the world, but let's say 2.5% to 4%, you would see a complete reevaluation of bonds and stocks, and particularly fixed income would have a huge drop, and I think you would see capitalization rates of what future earnings are for stocks would have to be reevaluated to affect a slightly higher interest rate. So the real scenario that eventually could end this bull market that we've had in both stocks and bonds is a pickup in inflation and central bankers therefore being forced to change their policies.
Interesting, Joe. That's Joe Terrell, founder of Terrell and Company, independent wealth management with $700 million in discretionary assets under management. And Joe, I'd like to wish you, your family, and your staff a happy holidays and a wonderful new year.
Thank you, Steve, and the same to your family and your staff, and certainly to all our viewers, all of our clients. We very much hope and wish you the best for a safe and fun holiday season.
See you in 2020.